Okay, so you want to own a paper mill. A giant machine humming 24 hours a day, spitting out clean white rolls destined for every office in America. Long-term contracts with Amazon and Walmart for packaging. The quiet satisfaction of owning a piece of civilization itself. Because the world will always need paper. That is the picture in your head, and it is not a bad picture. Paper mills built modern America. They built fortunes and small towns alike. Here is the problem. The paper mill you are looking at may already be a corpse. It just has not stopped moving yet. A paper mill is not really a paper business. It is a billion-dollar bet on natural gas prices, timber contracts, and the weather in China. It just happens to spit out paper as a side effect. And the moment you understand that, everything about how these mills die starts to make sense. The word paper mill hides four completely different businesses. Understanding which one you are buying determines whether you are inheriting a growing asset or a slow-motion bankruptcy. The first is a pulp mill. This is upstream, the rawest layer. It takes wood chips, cooks them in chemicals, and produces the fluffy fiber that everyone else buys downstream. The second is a paper mill in the traditional sense. Printing paper, magazine paper, office copy paper. This is the subtype dying fastest and dying most publicly. The third is a container board mill. Corrugated boxes, cardboard, the stuff that carries every Amazon package to your doorstep. This one is still very much alive. The fourth is a tissue mill. Toilet paper, paper towels, napkins. This is the most resilient subtype because pandemics come and go, but people never stop using the bathroom. Those four subtypes are not variations of the same industry. They are four different businesses that happen to share wood as an input and roughly the same machine shape. The cost structures diverge, the customer bases diverge, the competitive dynamics diverge, and most importantly, the direction of demand over the next decade diverges violently. If you buy the wrong subtype in the wrong decade, no operational excellence will save you. The market itself is walking away from you. Now, let me think about scale for a moment. A modern paper machine is not really a piece of equipment. It is closer to a piece of civil architecture. The machine itself is 200 meters long, roughly the length of two football fields laid end to end, and about 12 meters wide across the deck. It runs at speeds up to 100 kilometers per hour, faster than most cars on a highway, and it does this continuously for months at a time. The capex to build one from scratch runs between $1 and $3 billion, depending on size, product mix, and how much of the pulp production is on site. That is not a small business investment. That is the price tag of a mid-sized commercial airport or a professional football stadium sitting in rural America. There is no mid-market equivalent. There is no starter paper mill you can grow from. You either enter at industrial scale or you do not enter at all. You do not stumble into paper mill ownership. Nobody flips one on the weekend. The financing itself requires banks that specialize in industrial infrastructure. Now, the visible cost stack. This is what everyone sees when they open the profit and loss for the first time and starts pattern matching to normal businesses. Wood fiber is roughly 20% of operating cost. Chemicals for pulping and bleaching are another 15% or so. Labor is around 15%. Depreciation eats another 15% because the machine is so expensive to install and refurbish. Logistics, mostly rail and truck, takes about 5%. These six categories together look like the operating budget of any large industrial facility. Rail, chemicals, wood, wages, depreciation. Nothing unusual, nothing alarming, nothing that screams trapdoor. Add it up and you have covered 70% of the cost structure. It looks manageable. It looks like a normal industrial business with normal industrial risks. A first-time buyer looks at this stack and thinks the risks are manageable. They negotiate wood contracts, they monitor labor, they plan capex, they feel in control. This is where the naive mental model starts to break down. Because the missing 30% is not one line item. It is the entire ballgame. Now, one more thing before we move on. A paper machine cannot be scaled down easily. There is no small mode, there is no idle mode. You cannot run it at 40% capacity to match a weak market and expect to earn 40% of the revenue. Everything is built for full throttle operation. That means when demand softens, your unit economics collapse in a way that would not happen in almost any other manufacturing business on Earth. The dryer sections still consume the same steam. The bearings still need the same maintenance. The mill town still needs the same headcount to function. You cannot rent out half the machine to another paper company. You cannot Airbnb the pulp digester. It is either running or it is not. And when it is not running, It is not depreciating slower. It is depreciating faster because industrial rust starts within days of shutdown. So the fundamental question is not, can I run this mill well? It is, am I standing in front of a mill that still has a market at all in this decade? The four subtypes answer that question in radically different directions. Printing paper is in structural decline of roughly 4 to 5% per year. Containerboard is growing at 2 to 3% per year, driven almost entirely by e-commerce packaging demand. Tissue is flat but stable. Pulp itself is cyclical, tied to global demand from China, which absorbs a huge share of world hardwood pulp production year after year. So before you touch any operational spreadsheet, before you tour the site, before you meet the union representatives, ask one question. What decade is this mill built for? If the answer is coated printing paper, 1998, you are buying a corpse. If the answer is kraft linerboard, retrofitted 2019, you might have a business. The four subtypes are not equal. They are not interchangeable. Getting this single decision right matters more than every other decision you will make about the mill combined. Now let us talk about what nobody prices in until it is too late. The single largest hidden cost lever in this entire industry. Every ton of paper you produce requires between 10 and 12 million BTUs of energy. That is the equivalent of burning roughly 4 barrels of oil per ton. Multiply that across a mill producing 400 tons per day, and you are consuming energy at the scale of a small city. Every single day. Without pause, the steam alone, needed to dry wet pulp into finished paper, accounts for the majority of that energy load. Steam is not cheap, and it does not store. You cannot buy cheap gas in summer and save it for winter. You burn it as you need it, at whatever price the market gives you today. In a well-run paper mill, energy costs represent 25 to 35% of total operating expenses. In some legacy mills, it exceeds 40%. Compare that to a normal factory. Energy is usually 5 to 15% of costs. In paper, it is the biggest single line, and it moves independently of anything you do. That is double the cost of the wood itself in most operations. Read that again. The wood is not the biggest input. The energy to cook the wood is. So here's the thesis. A paper mill does not really sell paper. It sells cheap energy converted into cellulose fiber and shipped in rolls. The paper is the receipt. The energy is the product. And if your energy contract goes the wrong way, no amount of operational skill can save the profit and loss. This is not a metaphor. This is the actual profit driver of the industry, and it explains almost every major structural shift over the past 25 years. Why did so many American paper mills close between 2000 and 2020? It was not because Americans stopped using paper. Demand for containerboard actually grew. The mills closed because Chinese mills had cheaper coal, cheaper labor, and government-subsidized power rates that no private American operator could match. And the ones that survived either had captive hydroelectric supply from a dammed river next door or long-term natural gas contracts signed before shale prices spiked. Every long-serving mill you can name today has one of those two structural advantages: cheap captive power, or a legacy energy contract negotiated in a different market. That is not a paper problem. That is an energy problem, quietly wearing a paper costume and pretending to be about pulp instead. Now, the wood side of the equation has its own trapdoor. Most paper mills lock into long-term fiber supply agreements with regional timber companies. These agreements often run 10 to 20 years. They guarantee volume, they guarantee minimum quality, and they almost always contain something called an escalation clause. The escalation clause ties your wood cost to a public index, typically the producer price index for pulpwood, adjusted quarterly or annually over the life of the deal. That sounds fair on paper. In a stable economy, you barely notice it. In an inflationary environment, it silently transfers all input risk to you because you cannot renegotiate mid-contract. The counterparty is a landowner cooperative with a 50-year memory and lawyers who wrote these contracts before you were born. Wood, in the paper business, is not really a commodity you buy. It is a contract you inherit, and the contract writes the terms of your operating margin decades in advance. Meanwhile, the price of paper itself is set by global commodity markets, not by your local costs. You are a price taker on the output side. You are a price taker on the input side, and the only variable you truly control is your energy contract, which itself is tied to natural gas futures. Do you see the shape of this? You are running a $2 billion factory whose profitability depends almost entirely on commodity spreads. 3 commodities, in fact: energy, fiber, finished paper. Move any two of them the wrong way at the same time, And you are not running a paper mill. You are running a hedge fund. Except unlike a hedge fund, you cannot exit your position. You have $100 million of illiquid capital equipment bolted to a concrete slab in rural Maine. A hedge fund can close a losing position with a keystroke. A paper mill can only close by writing checks. Big checks. To banks, regulators, workers, lawyers, all at once. None of this is decoration. None of this is a side detail. This is the entire structural reality of the business, hiding behind the words paper company. And this is why the American mill closures accelerated after 2010. Not because demand vanished, because the energy arbitrage that once favored American producers reversed. Cheap shale gas helped for a few years. Then the Chinese ramped up their own capacity at scale. Then the strong dollar made American exports uncompetitive. The mills that closed did not run poorly. Many of them ran beautifully, right up until the last quarter before shutdown. They simply lost the energy war. Their operators still show up in industry conferences today. Well-respected, well-informed, ran clean operations, made every reasonable decision, still lost. Structure eats operators. So when you look at a paper mill for sale, the first question is not how efficient is the machine. The first question is, what is the energy contract? And the second question is, how long is the contract, and what happens when it expires? Because the entire equity value of the business lives inside that answer. The wood contract matters. The labor pool matters. The location matters. But energy is the master variable, and everything else is priced against it. If you cannot describe your mill's energy strategy in one sentence, you do not own a paper mill. You own a paper-shaped time bomb ticking on somebody else's clock. Here is a fact that changes everything about how you evaluate a paper mill. Between 70 and 80% of the total cost structure is fixed. Fixed means it does not scale down when your revenue scales down. Fixed means it hits your profit and loss whether the machine runs at full capacity or half capacity. Interest payments on the $2 billion capex. Depreciation on the equipment. Property taxes on hundreds of acres of industrial land. Skilled maintenance staff you cannot let go, because if you fire the head boiler operator on Tuesday, you cannot hire another one on Wednesday. That level of skill does not exist on demand. Preventive maintenance schedules that cannot be postponed without regulatory violations and insurance exposure. Environmental compliance costs that are the same at 40% capacity as at full. Add all of that together, and you get a business where 70% of costs walk in the door before you produce a single ton of paper. You have not shipped a single ton. You have not billed a single customer. Yet 70% of your annual cost has already committed itself to the calendar. In most manufacturing businesses, if demand drops 30%, you cut costs by 20% and preserve most of your margin. In paper, you cannot. If demand drops 30% in paper, your revenue drops 30%, and your costs drop maybe 5%. Everything else stays glued to the balance sheet, which means margins do not compress in a slowdown. They evaporate. And when they evaporate, they take equity value with them, quickly and without warning. That is the difference between a business with operating leverage and a business with fixed cost leverage in the wrong direction. Paper mills sit on the wrong side of that line. Now, here is where the psychology becomes just as important as the math. Because you would think a rational owner would shut the machine down when it is losing money. You would be wrong. Because of a mechanic almost nobody outside the industry understands. The cost of stopping a paper machine is catastrophic. If a modern paper machine sits idle for more than 72 hours, the residual pulp inside dries into a cement-like layer coating every roller and dryer surface. To restart from that state requires a full cold start procedure. Cleaning, recalibration, reheating tons of steel to operating temperature over days, sometimes weeks. The cost of one cold start ranges between $5 and $10 million, depending on the machine size and how badly the shutdown was managed. Compare that to a normal factory, where you can flip the lights off on Friday, come back Monday, and lose nothing but a weekend of production. In a paper mill, a bad weekend can wipe out an entire quarter of profit. So owners do something that looks insane from the outside. They keep running. So the machine keeps turning. Every hour, every day, every quarter. Regardless of whether the finished paper is selling for a profit or a loss on the open market. They keep running even when the market price of finished paper is below their marginal cost of production. They keep running because stopping costs more. The industry has a word for these operations. Zombie mills. Alive on paper, dead in the numbers, still consuming resources because the shutdown cost is worse. At any given moment, industry analysts estimate that between 15 and 25% of American paper capacity is running in zombie mode. losing money per ton, but losing less than they would lose if they idled the machine. And here is where the trapdoor becomes a trap inside a trap. Because zombie mills flood the market with paper that should not exist at those prices, which suppresses the market price for everyone else, including healthy mills, which pushes marginally healthy mills into zombie territory, which floods the market further, which pushes more mills into distress. This is how consolidations happen. Nobody in the industry likes this feature. Nobody designed it deliberately. It is an emergent property of a business where stopping is more expensive than continuing to lose money. This is not an accident. It is the business model. The industry cannot self-correct through gradual capacity reduction. It corrects through violent, discrete bankruptcies. You either survive long enough to buy your competitor's mill at auction for 10 cents on the dollar, or you become the mill sold at auction. There is no gentle middle. The closure cost of a paper mill, if you actually want to shut it down for good, runs between $50 and $100 million, sometimes more. Environmental remediation of the site, decommissioning of chemical storage, severance obligations, ongoing liabilities under state and federal environmental law that survived the closure by decades. So even the exit is not really an exit. Even walking away costs the equivalent of a small tech company acquisition. And there is often nobody buying the land. You do not own the mill. The mill owns you. From the moment you sign the closing documents until decades after the last roll ships out. This structural feature explains why paper mill ownership has become concentrated in a handful of industrial holding companies with balance sheets large enough to absorb the volatility. Private equity generally avoids the sector, and when they enter, they exit through bankruptcy court more often than through a strategic sale. The small operators, family businesses that ran paper mills for 3 generations, have almost entirely disappeared. Not because they were bad operators, because the structure ate them. They tried to compete. They ran good facilities. Then a cold winter, a bad contract, or a customer defection pushed the fixed cost math past the breakpoint, and they were gone. Let me tell you 2 stories. Real names, real companies, real bankruptcy filings. Both of them illustrate exactly how this structure kills companies that look healthy on paper. The first is Verso Corporation. If you have never heard of them, that is telling. In 2015, they were the largest producer of coated printing paper in North America. Coated paper is what magazines are printed on. Glossy catalogs, advertising inserts, direct mail campaigns, the stuff that landed in your mailbox and now lives on Instagram instead. Verso had 5 paper mills across the eastern United States. They employed roughly 6,000 people. Their revenue peaked above $3 billion annually. They looked, from the outside, like a stable industrial company. Long history, blue-chip customers, modern equipment, skilled workforce, perfectly ordinary balance sheet ratios. Verso's story is important because it is the cleanest example of how a structurally healthy company can die from a demand shift it did not create and could not stop. Then smartphones happened. Not overnight. Slowly. Between 2010 and 2015, print advertising in the United States collapsed by roughly 40%. Magazines stopped printing. Catalogs went digital. The direct mail industry contracted year after year. Demand for coated paper fell off a cliff that had been forming for a decade. Verso's fixed cost structure did not care. The mills still needed to run. The interest payments on their debt still came due every quarter. The energy contracts still ticked. In January 2016, Verso filed for Chapter 11 bankruptcy with roughly $2.8 billion in outstanding debt. Their equity was completely wiped out. The company emerged from bankruptcy later that year, restructured, leaner, still trying to survive in a market that was structurally shrinking away from them. They closed the Wycliffe Mill in Kentucky. They closed the Bucksport Mill in Maine. They tried to pivot toward specialty grades. It slowed the bleeding but never stopped it. In 2022, a Swedish paper company called Billerud acquired the remains of Verso for a fraction of what shareholders had put in a decade earlier. The empire ended quietly. On paper, Verso looked healthy in 2014. In reality, they were already dead. The market had simply not priced it in yet, because bankruptcy is a lagging indicator. They did not die because they made bad paper. Their paper was excellent. They died because they made paper at all, in a subtype where demand was structurally gone. That distinction matters, because when a mill dies in this way, the workforce, the community, and the equipment are still perfectly functional. The market simply moved on. Now the second story, Northern Pulp, Nova Scotia. This one is different, because it kills the naive assumption that paper mill failure is always about economics. Northern Pulp operated a craft pulp mill in Pictou County, Nova Scotia, for decades. They employed hundreds. They anchored an entire regional economy. They were profitable most years. Their operations were technically sound. Their product had customers in Asia willing to pay competitive prices for hardwood pulp. But the mill had a problem that never showed up in the financials. For 50 years, it had discharged effluent into a body of water called Boat Harbor. Boat Harbor sits next to a Mi'kmaq First Nations community. The environmental damage was severe, well documented, and had gone unaddressed for decades under a bad faith agreement. In 2015, the Nova Scotia government passed the Boat Harbor Act. It mandated closure of the effluent treatment facility by January 31st, 2020. That was the deadline. Northern Pulp tried to build an alternative treatment system. They tried to pipe waste offshore. They tried to negotiate extensions. Every option ran into environmental review and public opposition. In January 2020, the deadline passed. Without a functioning waste solution, the mill had no choice but to shut down. The province refused to extend. It was the first major mill closure in modern Canadian history, caused not by markets, but by a debt owed to a community. That debt had been accumulating for 50 years. The company entered creditor protection later that year. The workforce was laid off. The regional economy of Pictou County took a hit it has not fully recovered from. Northern Pulp did not die because of paper prices. They did not die because of energy costs. They died because of a political and social risk. A risk no financial model would have captured. A risk that lived in the community relationships and regulatory history, not in the profit and loss or the balance sheet. This is the pattern. Not always the same trigger, but always the same outcome. Something the traditional risk analysis missed hits the mill, and the fixed cost structure does the rest. The numbers tell a story that connects both cases. In the year 2000, the United States had more than 300 operating paper and pulp mills. By 2024, that number is under 150, a 50% contraction of the entire industrial base in a single generation. Roughly one mill closure every month. Some of them died from smartphones. Some died from Chinese competition. Some died from natural gas price spikes. Some died from environmental lawsuits. Some died from bad acquisitions. But almost all of them followed the same trajectory. Looked healthy until they did not. Filed for bankruptcy or shut down when they did not. Never re-emerged in the same form again. The trajectory rhymes even when the causes differ, which is what makes it a structural pattern rather than a coincidence, and which is what makes the industry so hard to survive. The lesson is not that paper mills are bad businesses. The lesson is that they are businesses with hidden trapdoors, and the trapdoors do not appear in the due diligence, until they do, and then it is already too late to sell, restructure, or run for the door. Because the door is $100 million away from where you are standing. Now, let me lay out the two realistic scenarios you are likely to face if you actually try to own a paper mill in the mid-2020s. Scenario A is the optimistic case. You are buying or building a modern containerboard mill, kraft linerboard for boxes, or a tissue mill for consumer paper products, subtypes with structural growth or resilience. Your capex is roughly $1 billion for a greenfield build, or $400 to $600 million for an acquisition of an existing modern mill. You lock in long-term supply contracts with Amazon, Walmart, Costco, or a major consumer goods company. 10-year deals with volume commitments and pricing formulas indexed to input costs. You secure a natural gas contract or partial cogeneration setup that protects you from energy volatility. You negotiate reasonable fiber supply from a diversified pool of landowners. In a good year, revenue lands around $600 million. EBITDA margins run between 18 and 22%. That is roughly $110 million in EBITDA. After interest expense, depreciation, and taxes, you clear somewhere between 30 and 50 million in net income. Return on invested capital hovers around 8 to 10%. Payback on your capex takes 8 to 10 years, assuming nothing catastrophic happens during that window. In this scenario, the mill is a legitimate business. Not spectacular, but a real one. It generates cash. It pays down debt. It provides employment. It occupies a defensible niche in the packaging supply chain. This is scenario A. Scenario B is what most first-time paper mill buyers actually walk into. You acquired the assets of a legacy printing paper mill out of bankruptcy for pennies on the dollar. The seller was desperate. The valuation looked incredible. You paid $200 million for a facility that cost $800 million to build 15 years ago. Bargain. The problem is that the mill was built for a product nobody wants anymore. To convert it to containerboard requires $200 million in additional capex. Retrofitting the paper machine. Adding a new pulping line. Upgrading the wastewater treatment. rebuilding the winder, and finishing sections. That is a 3-year project minimum. During those 3 years, you are burning cash. You either mothball the mill and lose your workforce and community goodwill, or you keep running the old product at a loss. Halfway through the retrofit, natural gas prices spike. Or Chinese producers dump containerboard on the North American market at prices below your marginal cost of production. Or a new environmental regulation adds 10 million per year to your compliance cost. Or your anchor customer moves their business to a competitor with a newer facility. Any one of those events, and your model breaks. Not gradually, immediately. Because your fixed cost structure gives you no room to adjust when revenue falls short. You now owe your bank $200 million in retrofit financing, plus the original acquisition debt, plus operating losses that are not covering interest. This is when zombie mode begins. You run the mill because stopping it costs more than continuing. You hope for a market recovery, you cut whatever discretionary spending you can find. It is never enough. Within 5 years, roughly 7 out of 10 Scenario B mills end up back in bankruptcy court, sold again, to another optimistic buyer, who repeats the cycle. This is not pessimism. This is what the data actually shows across the last 3 decades of paper mill acquisitions in North America. The pattern is consistent. Industry surveys suggest that of the roughly 150 paper and pulp mills still operating in the United States today, about 1/3 are genuinely profitable and sustainable. Another third are technically operating but not generating returns above their cost of capital. Zombie territory. Running to avoid shutdown costs, not because they are creating value. The final third are in some stage of restructuring, closure, or forced sale. They are the next round of statistics, and everyone in the industry knows it. So circle back to the picture I painted at the beginning of this video. The giant machine humming 24 hours a day. The white rolls destined for every office in America. That machine is real. It exists. You can walk into a mill in Wisconsin or Alabama or Maine right now and see it running exactly as I described. But what is coming out of the machine is not paper. Not anymore. Not in the way it used to be. What is coming out is your capital, roll after roll. The mill you thought you were buying was a business that manufactured product. The mill you actually bought was a business that manufactured obligations. And obligations do not stop. They do not slow down when demand slows. They do not shrink when the market shrinks. They compound quietly, month after month, until one board meeting where somebody says the word restructuring. A paper mill is not really a business you own. It is a century-old bet on cheap energy and stable demand that you are inheriting from previous generations of American industry. And the odds on that bet are being rewritten every single year by forces you do not control. Chinese energy policy, global commodity spreads, digital displacement of print media. The romance of American manufacturing is real. The mill towns are real. The pride of the workforce is real. The engineering is genuinely remarkable. All of it is real. But the economics of American paper are already gone. And the sound you hear when you tour that mill is not the sound of a business making money anymore. It is the sound of the last generation of a dying industry, still moving, because nobody has told the machine that it can stop.